morning, everyone. It's Shauna, the Tax Goddess. I get asked this question over and over and over again, which is, what should my salary be, Shauna? Now, this answer really depends on who you are, whether you're married, do you have kids, what format is your business? Is it an LLC, an S corporation, a C corp? Are you a partnership? Are you a Schedule C? So, of course, as you guys know, one of my favorite answers in the tax code is it depends. The answer is it depends, guys. Now, I want to talk about some big picture kind of things, and then we'll drill down into some details. So, the very first one is that if you are a Schedule C sole proprietorship, now this is about how you're taxed, not your legal entity, right? And we've talked about this difference before. You can have a legal entity, for example, of an LLC, and be taxed as a Schedule C or an S Corp or a C Corp, whatever that is. If you are a Schedule C business, you do not want to pay yourself, as the owner, you do not want to pay yourself salary, okay? That is actually the incorrect way to take money from your business as a salary from a Schedule C. But if you're taxed as an S Corp or a C Corporation, it's actually required by law, by IRS, that you do have a salary. Now, so this is what this conversation is going to focus a little bit more on, is what is this by law? How much should my salary be? But if you have other questions, I am a Schedule C and I did take salary and I think now I'm in trouble. What do I do? How do I fix it? Throw those questions down in the comments below, because of course we will try to answer those for you and make sure that we can get you answers and get you help. So now let's talk about, you are an S Corp, you are a C Corp, and S Corporation, C Corporation, and you are paying yourself wages. Now, at the moment, okay, the IRS has one of two rules that you can follow to understand what your wages should be, all right? And the first one is related to the profit in your company. So if your company has made $100,000 of profit meaning your gross income minus your expenses, that is your profit. So if you've made $100,000 of profit before the owner's salary, your salary needs to be a minimum of 30% of whatever that profit is. So if it's $100,000, your salary should be a minimum of $30,000. Okay. Now, that is the first rule. If you follow that rule, the IRS will basically stay happy, right? You're paying at least 30% in salary, which means the IRS is getting Social Security taxes on 30% of that income, right? On 30% of $100,000. Now, the next one really, the next one is really related to the max cap, okay? What is the maximum amount of income that you should take? This is where it gets a little more difficult, okay? The max cap on Social Security tax, that income currently in 2020 is $137,700, so 137,700 per year, okay? Now, that can be kind of this middle ground as far as wages, all right? So we're going to come back to that number here in a minute, all right? So let's take a different example. You have an S Corp or C Corp, and your company is making $10 million, okay? If we were to follow the 30% rule, that means that your wages should be $3 million, okay? That's not always correct. The second rule that you have to follow is, if it's not 30%, the second rule you have to follow is something called reasonable compensation. So really what you're looking at is, how much would you have to pay someone to do your job if you are out of the office, if you're out of the country, if you're out sick for 1 year? What would that salary be if you had to hire somebody to do your job? Okay, so if you're making $10 million, to hire a new CEO might be $1 million instead of $3 million. Okay, so this is good. Your salary can be $1 million. All right. Now let's come back to that Social Security cap. All right, the one right in the middle. So let's say you're not sure which way to go. Okay, if we take that 137,700, right, as the Social Security cap, that is where the Social Security taxes get dropped from 15.3% all the way down to 3.7%. Okay. Now, really, what's going to end up happening there is any dollar. So 137.7, if you pay yourself 150, the amount of Social Security taxes on that difference, the 137 to the 150, is only 3.7%, versus anything under the 137.7 will have the full 15.3%. Now, I realize that I'm talking a lot of numbers, okay? And really what you want to be looking at here is make sure you're following one of the two rules, either the 30% of income or that you're using reasonable compensation, right? Either one is fine. Okay, so there's a planning in there, right? If your profit is really, really, really low, go with the 30% versus reasonable compensation. Okay, so there's some planning that can be done in there. But if you're close to that Social Security income tax max, right, you may want to consider whether reasonable compensation, if you are making $10 million, but you as an owner don't do anything, right? You have staff, you have teams, you have people, you have all sorts of things that are doing everything, and you're just kind of sitting back collecting a check. You might want to consider how much your wage actually needs to be. And that could save you a significant amount of taxes and, of course, give you much more opportunity to use the corporate income that's left over after your salary for tax planning ideas, like setting up a medical expense reimbursement program or paying your kids instead $18,400 a year for paying your kids that has zero tax on it. Okay, so there's some cool things that you can do with your wages. And unfortunately, guys, I love to give you a specific answer, right? Do this, do this, do this. The answer to this one is it depends. So as long as you're following at least one of those two rules, either reasonable compensation or at least 30% of your profit before the owner's salary in owner's salary, you should be good. So as usual, guys, if you have any questions, don't hesitate to put them down below. And you guys know Tax Goddess helps 6, 7, and 8-figure entrepreneurs grow wealth, put away for retirement, reach their dreams, buy a boat, whatever it is that you want to do. That is what Tax Goddess does. So definitely don't hesitate to reach out to us. The last little thing I'm going to say today, guys, basically every morning I'm checking in on the Senate race, okay? And at the moment, we do not have the Senate race information. That has not yet been settled. We still don't know what's going on. So if we look at the current Senate race here, this is live as of right now, as of when I'm speaking, they are still counting, guys, okay? So the reason why the Senate race in particular is so important, and I know I'm probably going to be covering this every day until we know, okay? But the reason why the Senate race in particular is so important is because if the Senate hopefully stays a majority of Republican, we should not be seeing a significant tax increase. If it goes Democrat, we are probably going to see some serious tax increases, some significant additional taxes across the board, whether you're making $10,000 or $1 million a year. So this race, if you guys have any tabs still open, keep it open on your Google page or however you're looking at the internet. I would suggest that you go to Google and keep open this Senate race. Once we know this, we're going to know a lot more about what's happening in the tax world for the USA. So if you guys have any questions, again, don't hesitate to post them down below. Subscribe to our YouTube channel. Join our Facebook group, Tax Strategies That Save Entrepreneurs Thousands. And in the meantime, I hope you all have a wonderful day, and hopefully I'll see you guys soon. All right, thanks. Bye.